This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. In this video, I'll be going over the data sets and doing a fairly quick technical analysis over the SPY. This video will be pretty short, so just be aware of that. And just a reminder, I will be doing a 0 DTE slash scalping slash day trading class in tomorrow morning stream. That will be starting at anywhere from 8:45 a.m. to 9 a.m. But it won't be starting later than 9 a.m. 9 a.m. would be the latest. It will be free on this channel, so look forward to that. But I will be going over a lot of the basics that I use to consistently scalp and 0 DT trade. So I look forward to having many of you join me with that. Um, if you do have friends and family that like to trade as well, go ahead and invite them. I'd be more than happy to have plenty of people join that stream. So with that said, let's go ahead and jump into this video. Now, for Wednesday, March 4th, we had a fair amount of data early in the morning. The ADP non-farm employment change for February, and again, that's the totality of the month, came in slightly elevated compared to the forecast. However, again, this number should be a lot closer to about 180 to 240,000 a month compared to, this flimsy 63,000. I do believe this will be having a revision downward. The reason why is because we have been actively monitoring the ADP, weekly employment changes, and it does not reflect that whatsoever. It reflects a lot closer to that 30 to 40,000. So, um, not so great data in terms of that. The rest of the data, we had the global composite, global services, the non-manufacturing data. We had the employment come in slightly elevated compared to the last print, but still, it's a fairly cool number. A lot of this data came in fairly cool today compared to the expectation. Um, but the biggest data out of any of this really is that ISM non-manufacturing employment. I really don't know why they have it marked only as basically two tier in terms of importance. But this is showing that the employment for February picked up very, very slightly. So not a bad thing for the economy, but for people wanting to or expecting rate cuts and stuff, this does not help that. That's why we've been seeing, treasury related ETFs and the yields at least pulling upward in terms of the yields, but the treasury related ETFs taking a slight hit. Um, Beige book, we're going to quickly cover that. There wasn't a whole lot in this beige book, and I am going to swap that screen very, very quickly. So this is just the national summary for the beige book. However, I would heavily suggest reading over the entire summary. The very important parts I highlighted here, and I'm just going to quickly read it. This is for the overall economic activity. Although consumer spending increased slightly on balance, two districts reported ongoing declines, and many noted that sales were dampened by economic uncertainty, increased price sensitivity, and lower income consumers pulling back on spending. So that goes very, very hand in hand with what we've been really seeing is that even though they're saying consumer spending is increasing, um, it's very, very likely due to that inflation, even though I'm not on the inflation train, I don't think that's increasing. Um, it's a lot of the higher end consumers having to spend more, and a lot of the lower end consumers pulling back. So your lower end consumers starting to pull back is, a very, very troubling sign because that's saying that, you know, the lowest echelon of people are not able to freely spend anymore. That will definitely start to travel upward. So be aware of that. Now, for the labor markets, the part that I highlighted, and it's just a portion of the entire sentence, but 7 of 12 districts reported no change in hiring. So that's a very, very big deal. And they're trying to label this as stability in terms of the employment levels. This is not stability. Okay. Um, no changes in hiring is essentially a negative signal with the overall economic sentiment because everybody should be trying to hire actively. That's a natural part of a growing economy. When there is no change in hiring, when we've been consistently seeing the basically the labor demand diminish, and now it's almost to a point where it's non-existent. This is not a good sign. So overall, not the best beige book. This is telling us that there are concerns within the labor market and the overall growth of the economy. You may not say that in terms of the totality of things. Like, for example, it does say that wages rose at a modest or moderate pace. Um, Again, that's a lot of catching up with inflation. Remember, a lot of wages are still behind in terms of the totality of inflation and everything. So a lot of it's just playing catch up. So I don't like this beige book. It doesn't really give us signals that are showing any form of economic strength. Um, and I guess I shouldn't say I don't like this beige book. It tells us a lot of signals, even though it's really trying to skirt past them. So I do suggest giving it a read. It's always important to read the beige book. It's again, each Fed district talks to their local businesses. They get the firsthand knowledge of what's going on with the consumer market, what's going on with the labor market, if there's layoffs going on, etc., etc. So always a very, very crucial data set. Now, in terms of overall economic growth, remember that plateauing is not a good signal, okay? Generally a plateauing economy, which that's what the beige book is really trying to say overall, is, generally tends to lead to a slowdown within an economy. Not all the time, but generally that is what occurs, and that goes along with a lot of the different sentiment we talked about with the labor market over the previous year and all sorts of different stuff. So I won't ramble about that too much anymore. Let's talk about Thursday. So, Thursday, March 5th, we do have some important data sets, but nothing super, super crucial for the market, really. It's going to be Friday. Just to quickly paraphrase this, preface this to this data set is that Friday we do have the major quarterly OPEX for the SPY. So that's going to take the SPY down roughly a dollar 75, dollar 80 in terms of the dividend going out. Generally leads to selling within that OPEX. Not always, but generally it's going to be a pretty neutral or fairly bearish day. So be aware of that. We do have very, very crucial data on Friday as well. Um, with the entire sentiment of the market, and again, we've been discussing this for quite many weeks now, that we do think that, and I'm saying we, like I'm some overlord or something, but I think that we are really getting ready to enter into a bear market or a major correction. Anyway, Thursday, now that I've talked about Friday, we do have important data sets. We have the exports and imports, we have the jobless claims. I don't really anticipate a whole lot out of the jobless claims right now. We know that the economy basically isn't hiring people, and that fires are extremely, extremely staggered and slow right now. We have not been seeing hire or firing massively increasing. So as long as that does not occur, as long as we do not see this jump back up towards that 1.9 million, 2 million mark, as long as we don't see this continuing to increase, then that should allude to the economy not faltering or the labor market not faltering as bad as, potentially I think it can be. But I do really expect the initial jobless claims to start picking up. Main reason why is the holiday season is over. Many, many companies are getting ready to start cutting off a lot of these uh, seasonal positions. So we'll see how that goes out. We know that Walmart is basically saying that the lower end of consumers are basically not spending at all. And I guarantee you that will transition into people losing their jobs, unfortunately. So we'll see about that overall. But I don't really expect anything unless we see a major increase in the initial jobless claims. Do have the non-farm productivity quarter over quarter. That is very important. Um, Quarter 4 so far has been giving us fairly cool data, so that can bring cool data, which in the overall sentiment right now, that can lead to increased selling. Generally, that would lead towards a more, more buying within equities overall, because generally that's going to reduce the yields if we see some of that data pulling back and cooling down anyway. The forecast has the numbers pretty much, pulling back quite a bit. They have the unit labor costs increasing quite a bit. I don't think that's going to be the case. I do think this is going to be a lot closer to that 0%. So we'll see. It's really not a whole lot of important data unless something major within this data set occurs. So I wouldn't be too concerned about tomorrow's data. 10 a.m. factory orders, I don't care about that. Bowman speaks at 1:15. Don't really expect any volatility from Bowman. I do think that in terms of the overall pacing for the market, for the data sets and everything, is that the overall market is really going to be looking forward to Friday's data, because Friday's data is extremely important. That's when we have the non-farm payrolls, the unemployment rate, all that good stuff. Tomorrow's data, again, just is not that crucial unless we see something major. So let's go ahead and jump into the technical analysis.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
Now, I did change up the screen very slightly, so if you do like it, let me know. I added the closing price. This will be included when we do the live stream so that the actual price will be on the screen. Um, if you don't like it being in this position, I could always pull it up to top right of the Bollinger Bands over here. Just let me know your opinion on it, and we'll move it around to where everybody likes. Anyway, getting into the technical analysis on the daily time frame with the moving averages and Bollinger Bands turned on, let's go over what happened today. So we talked about how, at least in yesterday's video, I talked about how the extreme likelihood is that we're going to see an upward test of the 5 mile. We tested the lower bounds of it. We now needed to truly test the upper bounds of it. Now, the 5 mile today was at that 685.43, and the high of today was the 687.09. So the upper bounds of the moving average is generally that $1 to $2 above the range, the lower bounds being the $1 to $2 below that range. So this does qualify as an upper bounds test of the 5 mile. The market closed basically slightly under the 5 mile itself. Only by a whole 30 cents. Doesn't matter a whole lot, but in full technical terms, that does mean that the market closed underneath the 5 mile. It will be pulling the 5 mile down extremely slightly. However, the market is really positioning itself to be able to head upward or to be able to head downward. And I know that doesn't help in terms of overall technical analysis, but we will go over why I think we will be seeing a rejection from this 5 mile rather than an acceptance and pushing from that bottom range. I can't talk. Anyway, going over this is that we are starting to see all of our moving averages, and I really want to zoom in on this, is that we're really starting to see our moving averages pulling downward. And it's really like this range right here, all except now it's below the 50 mile, which makes it extremely, extremely bearish. We had the 5 mile test to the upside. From that 5 mile test, technically we also tested the 10 mile and the 20 mile. With the level being rejected, currently the overnight price is at 684.56. I don't really anticipate that to hold too much one way or another. But with this 5 mile range being tested, with the 20 mile and the 10 mile being tested, what this really opens up is this lower Bollinger. Now, we pushed very largely into that lower Bollinger, as of Tuesday's session. However, we did not secure that lower Bollinger close. Again, we closed above that level, which means that that did not give us that lower Bollinger day one with the lower Bollinger day two lower low. The mechanics were not in play there, and we talked about that. But what this is doing is this is going to continue pulling the 20 mile, the 10 mile, and the 5 mile down lower. If we see the 5 mile rejection, like I do assume is going to happen, then what this does is this opens the lower Bollinger to expand further to the downside. Okay. Um, if you've been watching the upper Bollinger and lower Bollinger over the last few sessions, is that the upper Bollinger has consistently been pulling downward, while the lower Bollinger slowly, but is starting to open up. And the reason why it's slowly is because it's based off of that 20 mile. It requires the 20 mile to really start pulling downward to expand the lower Bollinger and pull that upper Bollinger down further. But we've been seeing the upper Bollinger constantly being pulled downward, which does say that our upside is being tapered out. Because if we were to push into the upper Bollinger right this moment, then the upper Bollinger push would basically only take us up towards the all-time high. It wouldn't really push us too much further into that 700 plus range. So as bullish as that would be, it wouldn't really be setting any form of new territory. It wouldn't be creating any new levels at all. It would just be filling a lot of this gap. Not that I'm expecting some upper Bollinger push, but what I'm saying is because it's pulling downward, it is reducing our upside, at least within the current cycle. And this is why I do think that this is alluding to a bearish trend starting to form. Now, I do want to turn on the drawings and turn off the moving averages and Bollinger Bands. And one thing that is very, very crucial and important is that so far it looks like we're starting to reject this top range. Okay. Now, that's really important because if we reject that top range, what that is telling us is that very likely we're going to pull from the top of that previous yellow range all the way to the bottom. And if we continue to see selling from that range, for example, if we see the 5 month fully reject tomorrow, then what's underneath that range? It's this very, very bearish, dark, deep red range. And that would allow us to continue pushing downward. And even though we did close the cup, this can use a little bit further structure. I would like to see that, but that does allow us to build the handle on this cup as quick as this might look. Um, Allows us to form the inverse handle and finally push under this very, very strong liquidity channel or this very, very strong consolidation channel. And really take full advantage of this red liquidity. The market dealers at least have really been trying to set this liquidity up because they take it and are out. Take it and are out. Each time we enter this range, it's very, very briefly. Generally this is to kill positions, and they've been doing this both on the top end with this blue range and on the bottom end with this red range. However, we have been seeing this blue range starting to descend. The previous push could barely even muster the strength to actually push into that level without rejecting and forming a very large head and shoulders, which even now, with this neckline pulling down where it is, we're still starting to form this head and shoulders. Again, if we do not pull upward too much further. Um, with that said, that's truly kind of what I'm expecting is the 5 mall to be rejected. It's an extremely crucial level right now because it's not just the 5 mall, it's the 5 mall, 10 mall, 20 mall, and 50 mall. Okay, so you're testing four different very, very important moving averages. Um, you're testing that on top of extremely bearish structure. So there's a lot of signals that are telling me that the selling is going to pick up very, very drastically. And again, we do have the major OPEX on Friday. That's going to be taking, the SpyX dividend is on that day as well. So that's going to be taking off that whole $1.70 off of the top of price. So whatever the SPY opens at, say it opens at 680, remove $1.70 from that, and that's going to be the price come the pre-market. So SpyX dividends generally are fairly bearish. Not always, sometimes they do get bought up, but that does require very strong market sentiment. Now, there is something with the sentiment that could cause us to push upward, and that's the Anthropic ordeal. Is that Anthropic, as of I want to say last week, basically got into um, you know, heat with the White House, and the White House told all United States businesses to basically cut ties with Anthropic and stop using their services. Um, Anthropic is now in discussion with White House officials again to basically, come back online and be able to render their services. So we just have to be aware that that can be a potentially major positive catalyst to the upside. So be very, very cautious of that. Now, this is the hourly time frame, and I do apologize for showing all the liquidity channels on here. I can't really hide them too well on the hourly time frame, but this is that larger head and shoulders I've been talking about. I'm going to delete this circle just temporarily and delete this. This is that upside move I was really expecting. Um, Talked about how I didn't really expect it to push out that further or that far in terms of days. I just had that to visually show where the candles were going. But we do have this upside now from the bottom of the cup. We have that bullish structure, and potentially we're starting to build that bearish structure. If we see the continuation of this head and shoulders here, then that will give us the inverse handle that we've been looking for to continue pushing us downward. And not only will we push downward, but we will continue to form an additional inverse cup here. And that inverse cup, while building again very likely a smaller handle to the downside, will give us the liquidity to finally break through some of this, you know, much, much harder liquidity levels that we've been talking about. So that's what I'm looking for in terms of the overall daily time frame is that, or in the hourly time frame, is that we do have this potential bearish structure forming. Now, many people are looking at this and saying, okay, this can form a cup. Now, generally, I'd be inclined to agree. However, we've already established that this previous structure, and let me go to the 4-hour time frame, that this previous structure all the way to this downside here is an inverse cup. I mean, they've almost hit almost to the exact penny. Okay. This is a completed inverse cup. So is this going to take off of the prior liquidity to build a cup and handle out of that? Very, very likely not. Very, very likely this is trying to form its own structure here to either push upward or push downward. So far, we're seeing the structure to really push downward. I know it doesn't look like that with buying. However, generally with buying, you want to see downside movement to push upward. So really, really concerned about this level. If we do see this 5 mile rejection here, can get very, very brutal. Now, if we don't reject the 5 mile, if we do see the acceptance, like I talked about being a potential scenario, is that we just continue looking towards the top of this consolidation range, which again is going to be at that basically 192. So that would be the upside if we're really going to start turning bullish. I would be looking for that cup to form a handle if that is the case, but I'm not seeing that be the case. Now, very, very quickly, because I did want to make this video short, the reason why I don't think it's the case is that our VVIX is still extremely elevated. Now, we did see it pull down quite a bit today. We saw it drop all the way from the 115 all the way down to that 105. However, towards the close, it did pull back up towards that 107. So this is still telling us that, the VVIX insurance is still extremely elevated. Okay. Again, unless this breaches below that 98 range, the selling can absolutely pick up. And I talked about this a few days ago, and we saw that occur almost to the T. So be aware of that. This is still telling us that we are not out of the woods yet. In the overnight, we are seeing buying out of UVIX and UVIXY. And finally, I'm just going to end on this note, is that again, looking at the weekly time frame for the USD JPY, and I'll pair this with the DXY and the yen, is that this is super, super, super elevated. And not only is this elevated, this is forming a cup and a handle here, to really potentially start legging up even further. Every time the yen has been dropped to such a low level, the Bank of Japan has had to intervene. Now, we have been seeing some signals that potentially they are starting to do that. We have been seeing a slight bit of buying within the FXY. This is the weekly time frame, just again showing those unwinding events in, relation with the DXY, the USD JPY, the SPY, etc., etc. But today, we did see a little bit of buying out of the USD JP or out of the FXY, which is the yen, and potentially we're starting to form an inverse head and shoulders here, which potentially is telling us that we are going to start seeing buying to the upside. But what I really want to end on is TLT, is that TLT, if I can circle around to the symbol because I am blind half of the time, is that TLT has been extremely bullish. However, we have been seeing a little bit of selling, um, out of the previous few sessions. And going through the actual technicals of this all, turning on the Bollinger Bands, we fully expected to see rejection here. We truly expected to start seeing it up in this range. However, this pulled all the way up towards that top of the cup, formed the top of the cup, and now from the top of the cup, we do expect rejection. Okay. From this rejection, we are starting to pull down towards this 20 mile range. As of the overnight, we're actually at the 20 mile. This is a range that, well, generally I would not try to engage into longs here, is that we have our cup and handle formed here, which I apologize that all of my drawings have on a little bit haywire, but we do have, potentially our handle formed here. And if we see major unwinding start from the Bank of Japan, like I do think is going to start occurring, then what's going to start happening with TLT is that we're going to break above this 91 range, 92 range, and really start heading upward. Again, this 95 range is a major liquidity range that we've been eyeing for quite a long time now. And this is still very much within play, especially with the unwinding occurring. This, TLT has absolutely flown due to some of the previous unwinding events. So this is starting to look like an extremely nice long. Um, I haven't priced out contracts yet or anything, but truthfully, I would really like something that is about 4 to 6 months out. Um, no, you're not gonna get that joke out of me. Um, However, getting a leap at this point might be a very solid trade as well. Targeting that 96 isn't a bad idea, but within the short term, trying to aim closer to that 92 strike, I think would be a lot smarter. Very, very likely a lot easier to hit within the money. Just taking a super quick look at the options here. Let's see at Y. So for the 92 call, it'd be about 130, and that's the bid. Um, 132. Yeah, so it'd be about $130. Um, Extremely, extremely reasonable option. Gives you a whole 135 days to catch that strike into a, if you believe in my thesis and see what I'm seeing, then potentially this is a very, very nice long here. This is kind of the exact type of conditions we're looking for to enter into TLT. Now, the whole long end hasn't been, um, you know, bought up by foreign or by domestic investors yet, but this is starting to create the conditions where that can happen. And some of the data sets this week can also create those conditions. So I will be looking for very, very likely this head and shoulders to fill out a little bit more. I will be looking to buy underneath the 20 mile range. And again, I will be targeting those 92 calls. Ideally, 4 to 6 months out. If you want to get a full year and get a leap option or something, that would be, again, not the worst idea either. I do see quite a bit of upside in TLT. So, okay, we're going to end on that note. No, we're not. I'm going to finish on this note. Broadcom here, we have a major head and shoulders here. Okay. This is the daily time frame. Now, Broadcom had a very, very good earnings. Um, they have beat their expectations very much so within this earnings. However, it doesn't really defeat this major head and shoulders that we have built here. And not only does it not defeat it, is that it truthfully starts to build even more bearish conditions here. Is that because on the daily time frame, we're starting to get towards that upper Bollinger again, which could create the condition for puts. If you understand how I trade my upper Bollinger ranges, that would create the conditions for puts. However, with the current buying, it's slightly above the 20 mile range. All of the moving averages are still well below this 50 mile range. The 50 mile is at the 334. The overnight price action only has it at the 333. So it still has to truthfully fully challenge that level, has to challenge the 20 mile, the 10 mile, has to build a lot of resistance again, or a lot of support again. However, we are at this 200 mile range on the daily time frame, which generally that creates the conditions for a major bounce, but you do want to see it push usually a little further into this. So I'm not fully set on Broadcom's buying. We have been seeing some selling signals still throughout the night, even with Broadcom having a very, very, very quality earnings. So, okay, we're gonna end on that note. I will be streaming the day trading class in the morning, basically at 9 a.m. So hopefully y'all can join during that. But with that said, thank you for watching, and I will talk to you in the next one. Take care, everybody.